In this lesson, we will cover some of the key terminology that is commonly associated with commercial properties. Let's start with net operating income. Net operating income, also known as NOI, refers to the income a property produces before debt service and any capital expenditures. NOI is expressed on an annual basis. It equals the effective gross income, which is the actual income generated from the property, minus any expenses. For example, if a property has an effective gross income of $1 million and $450,000 in expenses, the NOI would equal $550,000. This is a very important number for a real estate investor because, as we will see in a minute, it is used to determine the value of a commercial property. Next, let's cover capitalization rates. Capitalization rates, also known as cap rates, refer to the rate of return on a real estate investment based on the net operating income of a property. Cap rates are used to determine the value of a property. The cap rate is found using the following formula. Cap rate equals net operating income divided by purchase price, or current market value. For example, if a property is being purchased for $2 million and has an NOI of $150,000, the cap rate would equal $150,000 divided by $2 million, or 7.5%. You can also use this formula to determine how much one should pay for a property. For example, an investor is looking to purchase a property with an NOI of $100,000. They want to purchase the property at no more than a 6% cap rate. The most they would be willing to pay is $100,000 divided by 0.06, or $1,666,667. The next key term we'll cover is return on investment, also known as cash-on-cash return. This represents the annualized return an investor will earn on their initial cash investment. For example, if an investor puts up $400,000 to purchase a property that generates $40,000 in profit the first year, the investor would get a 10% cash-on-cash return in year one. Going back to capitalization rates, if the investor were to purchase a property using all cash, the cash-on-cash return would equal the capitalization rate for year one. An investor's return on investment is a key metric, as it can be used to compare investment opportunities. For example, if an investor has the opportunity to purchase stocks in a company with a projected return on investment of 6% versus a commercial property with a return on investment of 8%, the investor can more clearly see that the real estate opportunity is a better option. Next, we'll discuss the difference between equity and cash flow. The net operating income is the cash flow from a property. However, there is also value in the property beyond cash flow, which is equity. Equity equals the current market value of a property minus the loan balance. For example, if a property is valued at $1 million, but there is an existing mortgage of $700,000, the equity will equal $300,000. $1 million minus $700,000. Initially, the equity in a property equals the investor's down payment. But as the cash flow in property increases over time, so does the value of the property. This means the investor's equity will grow beyond their initial down payment. While equity is value on paper, it can only be realized if the investor sells the property or opts to refinance the mortgage. Finally, we'll discuss pro formas. A pro forma is an income and expense statement for a property. It is produced by an investor and typically shows the current income and expenses for a property, along with future projections, based on the investor's knowledge of the real estate market. Overall, the pro forma gives the investor a more in-depth look at a property. The investor uses this document to determine the financial performance of a property and if the property would make a viable investment. The key terms we discussed in this lesson are included in a pro forma, along with several other details. That being said, let's go to the next lesson, where we will review a pro forma in detail.